For most Treasury professionals, the significance of tax to operational Treasury is pretty well understood. I mean, for some time now I've been working with treasurers, and it's understood that tax is a significant cost to the business, or depending on how you want to look at it, a contribution to the community. But Treasury metrics that you're all familiar with have to be assessed net of tax. So a proper evaluation of the cost of funds would be the net of tax cost of funds, or you always look at a post-tax return on investment. Exposures need to be hedged on a post-tax basis. So what you don't want is the underlying exposure being taxed in one way and the derivative hedge being taxed in a different way. Otherwise, you lose the symmetry. And what we've seen over the last few years is tax driving quite significant business decisions. So we've seen the corporate tax rate in the US resulting in stockpiling of cash overseas by a lot of farmers and high-tech companies, pharmaceutical companies, not farmers as in tractors. And from my professional perspective, from the 1980s probably to 2010, international tax corporates may have actually viewed their tax profile as a potential for a potential asset for monetization of their tax attributes. And I've certainly seen a number of transactions where corporates have looked upon their tax profile in exactly that way. How can we make money from our tax position in various jurisdictions? But very definitely the pendulum has now swung in the opposite direction to tax needing to be managed as opposed to a profitable aspect of the organization which could potentially be exploited. Now, the Base Erosion and Profit Shifting Initiative was adopted by the OECD in May 2013, largely as a consequence, one could take the cynical view, as budget deficits that needed to be funded by governments, but certainly by the outcry for a number of NGOs claiming that large corporates didn't pay their fair share. Now, I'm not sure how familiar you are with the BEPS initiative, but basically what it did was to introduce a comprehensive action plan by the OECD to encourage efforts to achieve specific objectives. And amongst these objectives is the development of rules on the tax treatment of intra-group financial transactions. Now, as we'll see, this presents tax authorities with more tools to examine an area over which many of them have been suspicious for some time, by which I mean corporate treasury. And it also highlights the growing need for close treasury and tax collaboration, which in certain markets has been the case for some time. So in the US, my experience in the Fortune 50 is that the head of treasury would normally head up tax as well. That's becoming more the case in some of the EMEA organizations. But what is for sure is that BEPS is going to require that collaboration to get closer. Now, you'll be relieved to know that I'm not going to rehearse a full summary of the content of the BEPS proposals. But what I hope to do is to point out where tax and treasury need to be talking. Or possibly, more likely, in my professional experience, where tax and treasury need to have some form of facilitated discussion, because often they talk quite a different language. I'd be interested to know in the audience how many of you have actually had any form of discussion about the impact of the Base Erosion and Profit Shifting Initiative on treasury operations. couple of people? Okay. I mean, this is a list of the proposed action points, and some have a very obvious relevance to Treasury. So, for example, Action 2, to the extent hybrid entities have been used in the tax and Treasury planning of the organisation, that will have to be looked at. And Action 4 that shows there's going to be a review of interest and other financial payments. Action 9, the tax treatment of risk and capital. Action 10, high-risk transactions, of which I'm sure Treasury is likely to form a part. Action 13 on documentation. Oh, sorry, yeah. Hybrids tends to mean an entity that is taxed in one form in one jurisdiction and another form in a different jurisdiction. So it would be, I'm not sure if you're familiar, the check the box type construct in the US, where you can elect for a particular organization to be ignored for tax purposes under US legislation. Okay. So Action 13, documentation. Now, Action 13 significantly expands the depth and the scope of the information that needs to be provided to tax authorities. And this is subtly going to influence, to a large extent, the interaction and the operation of tax and Treasury within multinational organizations. So of imminent concern are Action 2 on hybrids and Action 13 on documentation, both of which are due for implementation this year. And for example, the UK has already formally committed to implementing some of these measures, and many tax authorities have either expressed a desire to do the same as the UK and implement some of these BEPS proposals into their domestic legislation, or they've commented on why their tax systems currently accommodate the BEPS initiative. Now, the effect of this is actually to sharpen the instincts of the tax authorities with regard to their use. So Action 4 on interest deductibility, and Action 9 on risk and capital, and Action 10 on high-risk transactions are due for implementation in 2015. So as you can see, all of these subject areas are virtually upon us, and they are going to have to be thought about, both by tax department and by treasurers. Now, the significance of these proposals for Treasury as a whole is going to be clearly an increased scrutiny of activity. There's going to be an expectation of thorough documentation which details assumption of risk, reward, and responsibility of individuals within the Treasury function. There's going to be an open door for review of Treasury practice which follows the procedure outlined in the documentation. And what is going to happen is there's going to be an analysis of how activities are rewarded. This is what we call analytical review. They'll look at who is actually generating the profit from a particular transaction. Now, a more worrying feature of all this is that, as I said before, many tax authorities have indicated how they believe their legislation currently already complies with the BEPS requirements. And we're seeing in a number of tax cases coming through the courts in different jurisdictions reference to OECD principles when the judges make their minds up as to how something should be taxed or not taxed. So the whole OECD model treaty and the initiative of BEPS is very much upon us and shaping the way both governments and tax authorities think, and this is inevitably going to filter down into the way that Treasury-based transactions are viewed. Now, the most imminent changes, as I said, are on hybrids and documentation. Now, to the extent that you use hybrids in your business, this will already be the subject of intense review and reconsideration. And I'm involved in a number of discussions where corporates that have actually used hybrid structures are looking to reformulate how those structures work and what the implications of BEPS is for those structures. But I don't really want to focus on that because most multinational organizations will already have had significant discussion with internally and with their advisors over the implications. And if you're sat here as a bank, that won't actually make much difference, the hybrid concept, to how your cash management products are actually implemented and thought through by your corporate client base. But the impact of Action 13 is more subtle on day-to-day Treasury activities and points the way forward to how the Treasury tax partnership is going to have to work. And as I say, if you're here representing a bank, the types of questions that you're likely to get asked by your corporate client base vis-a-vis how your cash management structure satisfies or fits in with a particular view of profit creation as expressed in the BEPS formulas. So the proposal under Action 13 is to reform the existing guidelines on transfer pricing documentation requirements. Now, I guess you might say that all that sounds pretty dull. But actually, it's going to cause people a lot of headaches because from here on in, the Action 13 documentation approach, that should say Action 13, I apologise for that. I'll blame it on my secretary, although that's not particularly gracious, but it is her fault. Action 13 requires I wouldn't say that in front of her, by the way, so I hope she doesn't watch this, but that's pretty unlikely. Action 13 requires 3 files of documents to be kept: a country-by-country report, a master file, and a local file. Now, the country-by-country report is basically a template, and it has to disclose on one schedule characteristics of each taxable entity within the organization. So, at a glance, it's going to be possible for tax authorities to see which activity is undertaken by which entity in which country. And amongst the items that have to be reported amongst those items is intra-group transactions. And that, of course, is going to include hedging and funding and transactions, and may also need to be badged as such in the country-by-country report. So there's clearly going to be much greater visibility as a consequence of the BEPS initiative. Now, the master file has to be maintained by the parent, and it will disclose data on fairly fundamental issues such as supply chain, intragroup services. It's going to have to provide a functional analysis with principal value contributors identified, and central financing activities and transfer pricing policies are going to have to be explained around those financing activities. Now, you can see from all that the impact is going to be greater visibility of intragroup transactions. And it's going to be easier for tax authorities to undertake an analysis of value creation by reference to function, by reference to risk, and by reference to capital. And what will also happen is that corporates will be asked to show adherence to the stated policy and structure that they claim their treasury operates to. Now, I've had experience of tax authorities going into corporate treasuries with a questionnaire and asking, what do you do when you get into the office in the morning? What do you read off your screen? Who do you talk to within the organisation, and what about? If a decision needs to be made, who takes that decision? How do you reach a decision? Who makes the final decision? And what they're looking to do is undertake a functional analysis that looks to see where the value within the treasury function is actually created. We're also already witnessing the introduction of a BEPS type initiative, and you'll excuse the impossible noun BEPSification, but that was my term that was used in the conference document. But we're seeing BEPSification within local tax authorities on the basis that this is in line with people's understanding of OECD requirements and the BEPS obligations. So let's have a look at some of these implications. And by way of example, let's take the humble cash pooling activity. Now, most corporates I know look to price cash pooling activities by reference to spreads. Now, who here has heard of the ConocoPhillips case? Hands up. One person. Two people. Oh, three. A few people. Okay, because the last time I gave a talk like this, somebody from ConocoPhillips was actually in the audience. So, old as I am, I still learn by my mistakes. Basically, what happened in ConocoPhillips was that, unsurprisingly, a huge generator of their cash was Norway. And Norway participated in a cash pool. And ConocoPhillips was able to show that the Norwegian participant earned more from the cash pool than it would have earned had it deposited the same amount of money with a bank. The tax authorities said that's not good enough. Clearly, any form of comparable uncontrolled price in relation to a cash pool is an inappropriate measure for allocation of the benefit of the pool. Because outside of a group situation, you won't get a cash pooling activity. What you actually have to do is look for some sort of profit split allocation by reference to bargaining power. And the outcome of the ConocoPhillips case was that it rejected a basis of simple spreads for allocation of benefit from the pooling activity. Now, virtually every corporate I know that undertakes cash pooling prices it on the basis of bank spreads, LIBOR or LIBOR spreads. And the case decided on the basis of OECD principles, decided that that was wrong. We had another case, the Bombardier case, again looking at cash pooling. And in that particular case, again, the basis for allocation of benefit was challenged by the tax authorities. But outside of that, the tax authorities said that because you actually don't have sufficiently precise and complete transfer pricing documentation, we, the tax authority, can rewrite it for you. And the court agreed with that. In circumstances where your documentation isn't up to scratch, then it's up to the tax authorities to fill it in. Again, decided on OECD principles. Now, what we can see from that situation is that tax authorities are getting much more diligent in examination of treasury-type functions. I've seen cash pooling used for a number of different things, including sort of surrogate intergroup lending. And what is clear is that all of the publicity, as well as the provisions within the BEPS documents themselves, is going to give rise to much greater and deeper assessment of how transfer pricing works within Treasury. So what it's going to be necessary to do is for tax and Treasury, as I say, to have that dialogue. Now, you as treasurers know where the value is created. The tax people generally won't have nearly as good an understanding of where the risk is and who the people functionaries who actually create the value really are, or really sit, or really located, and what the implications of their location and their activity is going to be. So, as I say, in my experience of working with corporates in this area, what we've needed to do is to have joint Treasury and tax meetings where we end up just a sort of facilitator within the meetings so that people can determine between themselves how, first of all, the documentation needs to be structured, and secondly, what the right answer is in terms of allocation of risk, reward, people function, and then for the performance of the functional analysis as to where the value is created by Treasury. So that's the whistle-stop tour through BEPS and how we see BEPS currently affecting what corporates are doing, but more importantly, how tax authorities are beginning to shine the light on Treasury activity as a consequence of this heightened profile that Treasury is getting.